a lot of the people on our side of the business were fat and happy for a very long time. And so, because they lived on something other than the purchase business. So now they're trying to dig up as much as they can on the purchase side of the business. One of the things I'd be careful of is what lenders are saying to you. Now, there's a lot of lenders out there, in my opinion, that do a fantastic job. They vet people thoroughly. They make sure that they don't want to have any burn. But there's a whole lot of people out there that didn't know anything other than just be fat and happy for the last 2 years. And so they're trying to, and they'll tell people pretty much whatever they want to hear. Just in this last 2 weeks when I was supposed to be on vacation, but ended up working virtually every single day, what are you going to do? It's the way it is. But we've had a lot of situations where people came and said, well, I was pre-qualified, or I was pre-approved, and I had this, I had that. Well, then they call me with their situation. I look at it, and I can't do anything. I said, did you give the person all of your documents? Well, I gave them most of them. Okay. I had somebody yesterday, this is absolute truth. Yesterday, they said, on Sunday, they said to me that all that the person that they gave them the pre-approval did a soft pull. And I said, a soft pull? They said, yeah, they pulled one of my scores and they saw it. And I said, I don't know how that can be a pre-approval. And they said, what do you mean? And I said, because if you're going to get a pre-approval, the lender has to take the middle score. And if there's two of you, we got to take the lower of the two middle scores. So if they only ran one bureau, how would they know what the real number is? And how did they give you a pre-approval? They said, well, I've got the letter. I said, send it to me. I'll take a look at it. And sure enough, the letter said that. And I said, well, if you're going to count on that, I said, you may not be getting a loan. And I said, it might not be a problem at all, but you don't know. I said, so I would just advise, be careful what people are telling you. If you don't know the lender, if you know the lender, it's probably not a big deal. Somebody you've done business with in the past, somebody that you trust, not a big deal. But if it's somebody you don't know, and you call them up and they don't return a call right away, or whatever happens, just be a little bit more diligent in your follow-up. Just because they're telling people whatever they want to hear, as opposed to actually going out and doing their job the right way and making sure, and telling people what they need to hear, not just what they want to hear, okay? And we've been through that with several of you recently. So, but what I want to talk about right now, this is top of everything, is what I'm showing up here. This is what drives interest rates. Now, this is a 3-year look back on the U.S. 10-year Treasury bill. The U.S. 10-year Treasury bill, if you look at this trend line. This is right now, January. This is right here. This is today. That's what it shows right now. It's at 1.936. In order to find another time at 1.936, you got to go back to 11/3 of 2019. Now, what that means to you and I is that interest rates are at their highest point since November of 2019. Now, think about it. How many people, don't answer this all out, just think about it to yourself. How many people have you spoken to that did their pre-approvals back in December or November or October, whatever it happens to be? In their mind, what interest rates are they thinking? 3.5. Yeah, they're thinking 3.25, something of that nature. All of a sudden, they're now looking at probably somewhere 4.25, probably. Now, anybody know what the payment difference is on 1%, an increase of 1% in the interest rate? What's the payment difference?
Like almost $200.
What's that?
Like almost $200.
Well, it's about 12.3%. So whatever the payment, principal and interest payment was, add 12.3% to it, and that is probably what it's going to be now. Now that's a 1% increase in the rates. The last time we had this discussion was back in January, and I was talking to you about a 0.5% increase in the rates. It's gone up since we had that conversation. I mean, just take a look at where the rates were back here beginning part of January, and where they're at now. So that 0.5% increase that we saw at the beginning of January is now almost a full 1% increase in rates. And you're dealing with two things. You're dealing with not only how the payment's going to affect them, but it's just what would you do if your lender that you've been working with for the last 6 months says that your payment is now going to be principal and interest payment, it's going to be $2,200 instead of $1,980. How would that make you feel?
Very irritated.
What's that?
Very irritated.
Yeah, you're going to be blown. I mean, you're saying, I was $1,980, now I'm $2,200. That's over a 10% increase in my payment. I'm not prepared. They're thinking 3.25 and the rate's going to be 4 1/8 or 4 or 4 1/4, something like that. Mentally, they're not prepared for that. So, Casey, go ahead.
Is $4.50 per thousand still
No, $5.
$5? Okay.
$5. Got to go up $5. That same 10%. Okay? We were telling everybody $4.50. I'm telling them now $5. Then the only thing about $5, it's easy to calculate. The principal and interest payment. What Casey and I are talking about is if you have a $500,000 loan, if all you do is take the number 500 and multiply it times 5, that is approximately your principal and interest payment, $2,500. Mike calls it the ish, which is perfect. It's about this, okay? It's an ish. So it's $5 per thousand. So if you have a $400,000 loan, it's 400 times 5. $300,000 loan, it's 300 times 5. Not 300,000, 300 times 5. And that'll give you your principal and interest payment. Then you got to add taxes, insurance, and PMI if it's applicable in this case. So the thing I want to make sure is that everybody sees this morning, because as you can tell, they haven't come down. Now, people want to know, why is it doing that? Why is it going up so much? Well, numerous things have happened. At the beginning of the year, it started going up because the Fed said two things. They said they were going to raise short-term rates, and they also said they're going to slow down their purchase of mortgage-backed securities. They're going to start backing off of that, kind of phase it in. So that's what they did. But what's happened since we've had our last conversation about this is that all of a sudden, you're now dealing with the fact that, I don't know if you saw the employment numbers that came out last week, at the end of last week. They were blown away. They doubled expectations, which simply said to the Fed that, well, that means inflation is going to continue to go up. So not only are we going to raise rates, we might raise them faster. Now, again, that's short-term rates, not long-term rates. But long-term rates are affected in a intangible way, not a tangible way. Short-term rates, HELOCs, car loans, those things are affected immediately by short-term rate increase. Short-term rate increase doesn't mean interest rates are necessarily going to go up, but they might. In this case, they are because of all the other factors, especially the one on inflation. They're raising because they're expecting continually higher inflation. And that is probably true. So what we're dealing with right now is the fact that the Fed is saying, there's not going to be any relief in sight. Now, does that mean, give me 1 second, get it back up there. Come on. Okay. Oh, I don't know what that is. Okay. So does that mean that that's going to continue to go up? No, we don't know that. If I had that answer, and many of you have heard me say this, I would be on some exotic island doing a Zoom call with an umbrella drink in my hand. That's not the case. So in any event, nobody knows for sure. And those economic geniuses that all publish all these different things, they've all said we would be in this interest rate category in third quarter. It's happened in 6 weeks. So all those economic geniuses, they don't know either. Trust me. I mean, I thought it would be third quarter. In fact, I think I stood up at one of the connects earlier this year and said, I thought third quarter. Well, we've made it there in 6 weeks. Now, do I think it could come down? The answer to that is I do. I don't know that it'll come down on the short term, but I do think we will do I think we're going to see 3.5? No. Not unless something terrible happens. But I think we could see, 3 5/8 to maybe 3 3/4 up to maybe 4 3/8, something like that, which is not the end of the world. But it's, for you and I, like I said, it's two things. Number one, it's making sure people are still qualified because the numbers have changed drastically. The client you and I were working with last week, if the interest rates were 3 1/4, he'd have that house right now. But at 4, totally different. I mean, all of a sudden it doesn't work. The second thing is just the mental concept that a borrower that you and I have been talking to, and they've been thinking, 3, 3 1/8, 3 1/4, whatever it happens to be, and now all of a sudden it's 4, 4 1/8. That mental thing has got them nervous. The last thing I want to go into before I answer any questions for you is that I don't necessarily think this is going to slow the market down. As a matter of fact, the market is actually sped up. And again, you might have seen in the Friday's Finest a few weeks ago where I put in there, fear is the greatest motivator that we have. Two greatest motivators are love and fear. Fear gets people to action even quicker than love does, which is weird, but it does. So the fear of interest rates continuing to rise is moving people to action. Casey made a comment to me earlier this morning. We were chatting. He said, we've been telling people for 2 years to get on it now. Get on it now. Get on it now. Get on it now. And people have waited and waited and waited. And now, instead of getting a 3% interest rate, they're going to get a 4% interest rate. So things have changed, and that mentally affects people on how they're going to respond to you and to me. All right, now, questions. Casey, go ahead.
Just my dumb personal knowledge. When interest rates move about 1%, is that about a 12% change in their payment?
Yes.
The math?
Yeah, 1% increase is about just over a 12% increase in their payment. Now you can take the reverse side of that. If you have somebody like Coogan and I had this last week, where somebody wanted to buy at 610, and they easily qualify at 500. The thing is, the buying power decreases by that same 12% because of that 1% increase in rates. So if I was able to purchase at 600,000, now 12% less than that, I'm going to be buying at somewhere around 5 1/4, 530. So that is different. And let's face it, a 5 1/4 home doesn't look the same as one for 600,000. And what happens if you get real excited about the one at 575 or even 5 1/4, knowing that you're going to have to put an appraisal gap in there, and even if you've got the money, you're thinking, oh my gosh, now what am I going to do? So there's a lot of factors that come into play just because these crazy rates have gone up like they have. Let me see if this has changed at all. Hold on.
It's been going a little bit. It's been deviating a little bit.
Okay. Ah, see, it went down.
I think it's live.
Yeah. 1.936. So and that's what it does all day long. This is like ridiculous. I don't even like to watch it. I look at it in the morning and in the afternoon and say, okay, whatever it is, it is.
So I'm sorry, I missed the part of employment. What does that have to do with any of this?
Inflation. The higher employment, they had 500,000 new jobs. They were expecting around 250 million, 500,000 new jobs. What that means is that the Fed perceives that inflation is going to continue to grow because you have more people back to work. And then they do a secondary look and they say, what are salaries looking like, hourly pays? And as you already know, all of that's on the increase. That affects inflation. So because of inflation and the fear that inflation is going to get higher and higher as the year goes on, they're pushing things up. All right, good questions. Anything else?
Numbers get bigger because that's what numbers do.
That's exactly right. The numbers get bigger. more people to work means that people can charge more. If they can charge more, that drives inflation. All of those things will just keep pushing everything up and up and up. And I think that's what we're going to see, at least on the short term. I don't know what, the long-term impact. Lanier?
What's the minimum amount of time on those loans before you can refi?
Great question. What is the minimum length of time before you can refi? I'm going to give you two answers for that. The first answer is there is no minimum length of time. You can generally refinance after you've made your first payment. The only reason why you got to wait for that first payment to get processed. Now, lenders, and this is for your information, lenders don't want you to refinance until you've made a minimum of 4 payments, maybe even 5. And the reason why a lender doesn't want you to do that is they get charged back. So any money that the loan officer or the bank made, if you pay out, it's called the EPO, early payoff. If you pay off inside of 4 payments or 5 payments, the lender, the loan officer, and the company have to pay back whatever they earned. So, Lanier, to your question, there's no penalties or anything else that the consumer gets. The institution may get charged if there's a payoff inside of 4 or 5 months. Otherwise.
Is it a reasonable talking point to kind of say, buy now in case things continue to go up, and then, hey, if they happen to take a dip 6 months from now, just get that quick refi in?
Is that a good, I think it is. I think it's a good discussion because what you can tell people is you're not locked into this forever.
Yeah.
Now, we don't know if they're going to come down in 6 months, but whether they come down in 6 months or 12 months or 18 months, you're going to take advantage of it. Now, I want to share something, another thought that lenders go through. As much as this is difficult for people to stomach, there's a lot of lenders out there right now that are salivating over this. Because as interest rates approach 4.3, 4.5, 4.6, and when interest rates come back down into the 3s, and I don't know if that'll happen in 2 years or 5 years, but when it does happen, every one of these people is going to refinance. So lenders are salivating, saying, oh yeah, let them go up a little bit more, let them go up a little bit more. And then you can just bring them down sometime in the next 2 years from now, 3 years from now, and then we'll all make a lot of money again, which is a crazy thought, but that's what happens. So good point, Lanier. Anybody else? Anything else? Again, 2 things to bear in mind. Number 1, be aware of people who have been pre-approved prior to January to make sure that they're still qualified. And number 2, have a discussion with people so that they're not shocked when they find out interest rates are going to be approaching 4 or over 4 rather than in the low 3s. I know it's a hard discussion. If you're working with me, you don't have to have it. Let me know that I should have that discussion with them, and I will gladly do that so you don't have to. I've got a little speech I give to everybody. When we start talking about rates, I always tell them, I said, do me a favor. And they'll say, what's that? Do not shoot the messenger. And in this case, I am the messenger. It kind of softens things a little bit when I have to tell them that the rate just went up from 3.25% to 4%. And, so just, some lenders will do that for you, others won't, but if it's me, I'll always do that for you if you want me to. All right? Everybody, thank you. Good luck.